Hey everyone, this is Mike DeBliss. This podcast is on the case of Bedrosian versus the United States. I'm a little late in getting around to reporting on this case, as it was decided back in September of 2017 by the U.S. District Court for the Eastern District of Pennsylvania. It is a very important case as it's favorable for taxpayers who have failed to report their foreign assets on an FBAR. In that case, the district court revisited the FBAR willfulness requirement and held that the taxpayer was not willful in his failure to report one of his two UBS accounts on an FBAR. So, as many of you are aware, there are some opinions regarding willfulness vis-a-vis the FBAR that have been handed down by various courts over the last couple of years, and unfortunately they have not been favorable for the taxpayer, but this case is, and that's what makes this case so important to report on. So a little bit of background information regarding FBAR filing requirements. The FBAR, which stands for the Foreign Bank Account Report, states that a U.S. person that has a financial interest in or signature authority over one or more offshore financial accounts has to file an FBAR. Now, what triggers the filing of the FBAR is not only the fact that we are dealing with a foreign account, but also the fact that the high watermark balance of that foreign account exceeds a threshold amount of $10,000 in U.S. currency at any time during the calendar year. So there's a lot of nuances here that we have to unpack. The first thing being that the foreign accounts, are usually in foreign currency. So what has to happen is that there has to be an exchange, a currency exchange rate from foreign currency into U.S. currency to determine if that $10,000 threshold is exceeded. And so what happens is we use the end of year exchange rate that is in effect for that tax year. So basically, we'll use the exchange rate that is in effect as of December 31st of the year in question, and we will convert the foreign currency into U.S. currency to determine whether we have exceeded the threshold amount of $10,000. The other thing that is interesting about the FBAR filing requirement is that a taxpayer could have multiple foreign bank accounts, none of which exceed a high watermark balance of $10,000 at any time during the tax year. However, the FBAR filing requirement requires the taxpayer to aggregate these accounts for purposes of determining whether the $10,000 ceiling has been exceeded. So, for example, if there are two accounts, say account A and account B, and account A has a high balance of, say, $7,000 on October 1st of the tax year, and account B has a high balance of, say, $3,500 on, let's say, September 1st of that tax year. What would happen is the taxpayer would have to take the $7,000 high watermark balance from account A and then add it to the $3,000 high watermark balance in account B and come up with the aggregate amount of $10,000. And what I'll do is tweak it a little bit and say that account B had a high watermark balance of $3,500, and in that case we now have an aggregate high value of $10,500, which exceeds the ceiling of $10,000 and triggers an FBAR. So while neither account by itself qualifies for FBAR reporting because it doesn't exceed the $10,000 ceiling. When you aggregate both of the high watermark balances in the accounts, we now exceed $10,000, in this case by $500, and that triggers the FBAR filing requirement. So that's one of the nuances that comes or that accompanies the FBAR filing requirement. Now, how do we get to an FBAR violation? A taxpayer's failure to properly file an FBAR subjects that person to penalties. Well, what does that mean? And what triggers a failure? Well, a failure could be as obvious as neglecting to file the FBAR altogether when an FBAR should have been filed for that given tax year, or it could happen as a result of the taxpayer neglecting to include the accounts on the FBAR. So, for example, the taxpayer may report some foreign accounts on his FBAR while leaving off others. And if the taxpayer leaves off others, that is technically an FBAR violation. Now, whether that amounts to willfulness is up to the courts to decide. One might speculate that if the accounts that have been left off the FBAR are high net worth accounts that are in the neighborhood of high six figures, that there could be some willfulness involved, especially if the accounts that were reported are negligible in value. Be that as it may, there are two types of violations when it comes to FBAR penalties. One is what's called a non-willful violation. The other is a willful violation. Each one has a maximum penalty. So a non-willful failure to file or report a foreign financial account can subject the taxpayer to a civil penalty of up to $10,000 per account per year. And that has to be stressed, per account per year. So if the taxpayer has multiple accounts, each account separately could trigger a maximum non-willful civil FBAR penalty of $10,000. And if the IRS is auditing more than 1 year, we're now talking about multiple years that are on tap for possibly being penalized. So that has to be evaluated as well, because the combination of a non-willful civil FBAR penalty of up to $10,000 per account per year could cause the FBAR penalty to go up to the stratosphere. Now, if the failure to file a report or include a foreign financial account is willful, we've now upped the ante, and the civil penalty goes up to a much greater amount than in the case of a non-willful violation. So whereas the non-willful FBAR violation was a maximum of up to $10,000 per account per year, the willful penalty for failing to file an FBAR is up to the greater of $100,000 or 50% of the balance of each unreported account. And it would be, again, the greater of $100,000 or 50% of the maximum balance of each unreported account at the time of the violation per year. So one can imagine how the penalties for a willful violation could just be insurmountable in magnitude. In addition, a willful failure to file an FBAR may also expose the taxpayer to criminal prosecution. So let's back up and let's talk about this elusive term called willfulness. If any of you have been following my blog, you see that I've been writing a lot on willfulness, and there is a lot of articles to consume on the topic, and that was because there was a lot of case law surrounding willfulness that came about over the last 10 years and even longer than that, because the case that actually that actually provided the standard of willfulness for tax crimes was a case called Cheek versus United States, and that was decided back in 1991. So the term willfulness, just as a basic refresher, is not defined in the statute imposing the FBAR filing requirement. That's the first thing to understand. So the FBAR is actually administered by FinCEN, and if you were to go to the FinCEN's instructions on FBAR, you would not see a definition of willfulness. You would simply see it citing to the case of Cheek versus United States, and similarly, if you go into the Bank Secrecy Act and you look up FBAR, you won't find a statutory definition of willfulness. So the FinCEN that publishes the guidelines on the FBAR basically cites to this case of Cheek versus United States for the definition of willfulness. And in Cheek versus United States, the court basically established a criminal standard of willfulness for tax crimes. And that is the one that the IRS has adopted in its own Internal Revenue Manual. The definition is a voluntary intentional violation of a known legal duty. Now, this is a loaded sentence, voluntary intentional violation of a known legal duty. We could spend easily the next 3 to 4 hours deconstructing each of the elements here, because as many of you are aware, in legal parlance, each word has a precise definition, and that definition is oftentimes multi-layered. So while these, while this is a 7-sentence definition, it can devolve into a very heady discussion, and one that is not as black and white as you might imagine. But be that as it may, it's important to understand some basics regarding willfulness, and that is that it's a state of mind. And by state of mind, that means that it's what the person was thinking at the time. And so it's impossible to open up a person's head and look inside to see what they were thinking back on such and such a date when they didn't file an FBAR. And so what the courts do is they establish willfulness via circumstantial evidence. And that's basically the precursor for understanding willfulness in the civil area as well as in the criminal area. Circumstantial evidence, conduct, acts of the taxpayer are what is used to determine whether the taxpayer's state of mind was willful, whether it had a nefarious, or intentional modus underlying it. And the good news here is that when the IRS adopted the Cheek definition of willfulness, the definition, of course, was used in the context of willfulness for tax crimes. And that was a good omen, because the IRS was basically taking the criminal definition of willfulness and applying it when it comes to assessing civil penalties. And the criminal definition is a heightened standard. And that's because, we adopt the notion by the founders of the country that we aren't going to lock people up and deprive them of their fundamental interest in their liberty without ensuring that a heightened standard of beyond a reasonable doubt has been satisfied. And so this definition of voluntary intentional violation of a known legal duty is a heightened standard, and it's a good thing that it's being applied in the civil context for civil tax penalties, because a watered down or diluted definition would make it easier for the IRS to prove its burden for making out FBAR penalties in the civil context. So getting back to this notion of willfulness as being a state of mind and how it's established via conduct and acts of the taxpayer, there's also a theory for proving willfulness that circumvents the definition of voluntary intentional violation of known legal duty, and it's called willful blindness. And this is where a lot of confusion lies. Willful blindness is not as heightened a definition as the Cheek definition for willfulness for tax crimes. Willful blindness is defined as being subjectively aware of a high probability of the existence of a tax liability and purposely avoiding learning the facts. So what I oftentimes like to compare willful blindness to is this idea of having a surmising that there is a requirement or obligation in reporting something on a tax form, but digging one's head into the sand like an ostrich to avoid learning more about it. So again, having an assumption or a hunch, that's what I'm looking for, or a hunch that there could be a filing or reporting requirement that applies to you, but purposely digging your head into the sand like an ostrich to avoid learning more about it. That's it. The hunch is basically what is the predecessor to having to do more due diligence to determine whether the reporting form actually applies to you. And so just to recap that definition, it's a subjective awareness of a high probability of the existence of a tax liability and a purposeful avoidance of learning the facts. Now, in Bedrosian, in the Bedrosian case, rather, the government urged the district court to apply the lesser civil standard in the case, which finds that a person knowingly or recklessly violated the statute without requiring the government to prove improper motive or bad purpose. So essentially, the government was urging the district court to apply a willful blindness definition. However, the district court rejected the criminal standard of willfulness and went along with the government and applied the lesser civil standard. So right from the get-go, and I don't want to make this any more confusing than it might seem, the district court rejected the criminal standard of willfulness and went along with the government's argument that the lesser civil standard applies. And so the court found that the definition that applied for purposes of willfulness was that a person knowingly or recklessly violates a statute and the government need not prove improper motive or bad purpose. So that was a bit of a loss for the taxpayer, because the taxpayer is no longer, because the IRS no longer is held to this heightened standard of having to prove malice or bad purpose or intentional motive. Now, the good thing, however, is that the court still came to the conclusion that the taxpayer did not satisfy even the lesser standard of willfulness. So, let's talk about the facts of this Bedrosian case, along with some FBAR precedent. Now, the taxpayer in the Bedrosian case was an executive, a high-ranking executive in the pharmaceutical industry, and he traveled extensively internationally back in the 70s. And as a result, he established an account at UBS, which was Swiss Credit Corporation back then. During the period that his tax returns were prepared by his first accountant, which was between 1972 and 2006, the taxpayer never filed even a single FBAR. He later advised the accountant of his UBS account in the 90s. So not until the 90s did he advise the accountant of the existence of his UBS account. The accountant told Bedrosian that he had been breaking the law by not reporting it, but told him it wasn't a good idea to start reporting the account because the taxpayer could not go back and unring the bell or unbreak the law. What's done had been done, and because it's been several decades since his first account was established and that he should have been reporting the account, it would not behoove him to now all of a sudden start reporting the account. So that was the advice that the accountant gave Bedrosian. That accountant passed away, and a second accountant took over in tax year 2007. By that time, the taxpayer's single UBS account had been split up into two separate accounts. Now, the new accountant told Bedrosian to file annual FBARs. So he was on the up and up, and he knew that this could come to roost if the taxpayer did not get on the compliance wagon and begin filing annual FBARs. However, the 2007 FBAR that was filed, for whatever reason, reported only one of his UBS accounts, and that was an account with a balance of $240,000, a high account balance of $240,000 US, and it omitted the other. The other conveniently had a balance of approximately $2 million. So there's a lot of questions that this raises. If the accountant wanted Bedrosian to be on the up and up and was, acting as his advisor and steering him in the right direction, one would question why on this 2007 FBAR only one of the accounts was listed and not the other. And again, as we discussed earlier in the podcast, the omission of one account or more on an FBAR is enough to trigger a violation, especially if the omitted account is an account that is in the high six figures. And here, the omitted account actually had a high watermark balance of about $2 million. So a few months later, after submitting the 2007 FBAR, the taxpayer is notified by UBS that he could no longer keep his bank account open at that bank. The taxpayer sent 2 letters to UBS, one for each account, requesting that the funds be transferred to another Swiss bank. Unbeknownst to the taxpayer, his information was among the data that was turned over to the IRS by UBS. It's not clear how the IRS acquired this information, although speculation might be that it was through the FATCA, the Foreign Account Tax Compliance Act, and information sharing through a Model 1 or Model 2 treaty that forced UBS into turning over the names of its U.S. account holders to the IRS. But be that as it may, the IRS acquires this information about Bedrosian from UBS and what does the IRS do? It begins auditing Bedrosian's returns in April 2011. The district court began a very detailed analysis by noting, by backing their way into this definition of willfulness and asking the age-old question whether willfulness is present. And what they did was they reviewed the case law and they made some important points along the way. They mentioned that whether willfulness is present, is a question of fact that depends on the taxpayer's knowledge, intent, and state of mind. It's very similar in this way. It's very similar to a determination of probable cause in a criminal setting. It's very similar to the validity of a search warrant. So much of these criminal theories depend on the totality of the circumstances and are fact-based questions. And so they basically require a balancing of facts for and against the taxpayer or the defendant. So the question of fact, the court said, depends on the taxpayer's knowledge, intent, and state of mind. And the court went so far as to state that the taxpayer's testimony was credible, and they concluded that the taxpayer was not willful in his failure to report the larger of his two UBS accounts on his 2007 FBAR. Now, what the court did here was a very thorough analysis because it compared Bedrosian's behavior in failing to report that account to those of the taxpayers in 3 other key FBAR penalty cases. And these will probably trigger your memory right away. U.S. versus Williams, U.S. versus McBride, and U.S. versus Bucell. Those were 3 watershed FBAR penalty cases that were decided back in 2012 for Williams and McBride and back in 2015 for Bucell. And so the court does this analysis by comparing Bedrosian's behavior to those of the taxpayers in these 3 seminal cases and finds that Bedrosian's behavior was much less egregious than the behavior of Williams, McBride, and Bucell, where the court found that willfulness existed. The court indicated that Bedrosian was not willfully blind, even though he had taken it upon himself and proactively chosen not to receive regular statements on the UBS accounts and kept track of the accounts through annual meetings with a UBS banker. The court was not persuaded in any way by the litany of cases cited by the IRS. And the reason why is because the IRS cited, like I said, a slew of non-FBAR civil willfulness cases. And so the court found them unpersuasive because they did not relate to specifically to FBAR penalty cases. These were non-FBAR civil willfulness cases, and that's why the court found them to be unpersuasive. And, unlike the FBAR penalty cases that were previously mentioned, these non-FBAR civil willfulness cases did not deal with the same unique reporting requirements at issue. Specifically, the court declined to infer that the taxpayer was aware of the larger unreported UBS account and concluded that the government had not established that Bedrosian was anything more than negligent in not finding out about it. And so that is a key clue as to how the courts are going to review these willful FBAR penalty cases. What's clear from this opinion is that they are not going to be persuaded by cases that are outside of the FBAR arena. And so the government can literally dump as many non-FBAR civil willfulness cases as it wants into its briefs, but they are going to be found to be unpersuasive because the court wants to focus on the same unique reporting requirements that are at issue in an FBAR case, and the precedent for those for that are the cases that were spawned back in 2012 by U.S. versus Williams and U.S. versus McBride, and then in 2015 by U.S. versus Bucell. And so once again, the court in rejecting these non-FBAR civil willfulness cases, they compared the taxpayers' conduct in this case to that of Williams, McBride, and Bucell in the FBAR specific cases, and found that Bedrosian was not aware of the larger unreported UBS account that had a high watermark balance of $2 million, and concluded that the government had failed to establish that the taxpayer was anything more than negligent in not finding out about it. Now, just as a little bit of foreshadowing here, it'll be interesting to see if the IRS appeals the district court's decision. If they do, it would be to the Third Circuit Court of Appeals, and if so, what that appellate's decision will be. First of all, we have to determine whether the appellate court will even grant cert, meaning accept the case from the district court. If it does, then it'll be interesting to see whether the appellate court affirms or denies the decision of the federal court. But as of right now, the district court's conclusion in Bedrosian is taxpayer favorable. There's no question about that, and particularly in relation to prior FBAR penalty cases. The takeaway here is that the events and circumstances that were present in the Bedrosian case did not amount to willfulness. So if you have a case that is on all fours with Bedrosian, where one or more accounts was disclosed, but an account that had a hefty high balance wasn't disclosed on an FBAR, you would have a case that is similar to the Bedrosian case, and you would definitely want to cite that to the IRS revenue agent in the midst of an audit to prevent the revenue agent from assessing a willful FBAR penalty. So unless and until the district court's decision is reversed on appeal, as I mentioned, the taxpayers in similar circumstances can rely on the Bedrosian case to support their position that their failure to file an FBAR or to file a complete FBAR was not willful. Now, I say all of that with this caveat. Notwithstanding the fact that this is a taxpayer win, and wins like this are few and far between, and it's necessary to understand that at these FBAR failure to file cases are serious, and they could definitely result in civil penalties that could go all the way up into the stratosphere and leave the taxpayer with nothing more than the shirt on their back. So they have to be evaluated very thoroughly and meticulously, and one can't just take one or two factors into account. It's very important to holistically review all of the facts in a case and ensure that the taxpayer is on firm ground before pushing back or before making a decision as to whether or not to take advantage of one of the voluntary disclosure programs in existence, or whether to simply go back and file belated or late FBARs. So there are so many factors to consider in making this decision that one factor alone is often not enough, and you have to look at all of the circumstances of the taxpayer's situation in determining whether a disclosure through streamlined or offshore voluntary disclosure program is more appropriate than merely filing delinquent FBARs, or whether delinquent FBARs are more than sufficient in order to get the taxpayer into compliance. At the end of the day, the objective is to ensure that the taxpayer, does not, God forbid, have to deal with a referral of their case to the criminal investigation arm of the IRS, and B, that the taxpayer isn't strapped with fines and penalties that could leave them, possibly destitute. And unfortunately, that theme has played out in FBAR cases. If you have any questions, I strongly encourage you to reach out for your tax professional, or feel free to give me a call anytime at my office at 973-783-7000. I'm always willing to chat about issues relating to the FBAR.